Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome to the Alt Goes Mainstream Going Public series with Glenn Schorr. In this special series, we aim to make private markets more public. We take a deep dive into the public side of the alternative asset management industry. Our guide, Glenn Schorr, is a well-known Wall Street analyst who has covered alternative asset managers since the first firms in the industry have gone public. Glenn is a senior managing director and senior research analyst at Evercore ISI. Glenn has covered the financial sector since 2000 as a senior analyst and has consistently been named to Institutional Investors All-America Research Team for his coverage of brokers, asset managers, and exchanges in large-cap banks, most recently ranking number 2 and runner-up respectively in the sectors in 2023 and number 1 and number 2 in 2022. Listen in as Glenn shares market stories, the evolution of alternative asset managers as businesses, the biggest and most exciting trends in private markets based on what the industry's largest players are doing, and we also will go around the horn for his analysis on each of the publicly traded firms. Couldn't ask for anyone better to take us on this journey. Glenn and I hope you enjoy.
We're going mainstream.
Welcome, first episode of Going Public with Glenn Schorr and Michael Sidgmore. Welcome to the show. First, I want to start with your background because you've been an equity analyst since all the alts managers have gone public. So tell us a bit about your background.
Sure. I graduated Binghamton without a job because I had way too much fun in college. Got my first job in the back office of Chase Manhattan Bank downtown in a windowless dungeon by the vault. Did a lot of back office clearing and settlement stuff. Got to see the inner workings of a bank literally. Clawed my way out. After 3 years, got to the buy side at a place called MD SAS. Great place. Spent 6 years there doing back office stuff and then learning how to trade municipals and treasuries and some mortgages. Towards the end, managed some fixed income portfolios, got pretty good at it, had a good track record, and nobody cared about municipal bonds. It was the late 90s. There was this thing called the internet that was starting, and who knows, that's what people want to do. Had a little job envy. My wife was in equity research, and I was like, I want to do that. So made my way over, took a 67% pay cut, and for the last 27 years have been on the sell side covering big banks, brokers, traditional asset managers, the trust banks, and the alternative managers as they got public.
So that's where I want to start is the alts managers going public. You were there, front row seat, covering the first alts managers to go public. What was it like then? And how did investors think about these managers?
In the beginning, they didn't think about them that much. There wasn't a lot of liquidity. They traded at bad multiples. People were a little skeptical. Wait, if the smartest people in the room are selling, why am I buying? They were complex. The accounting stunk. They had K1s. They were publicly traded partnerships. Like they weren't in any indices. So you didn't need to own them. And they were perceived to have a lot of volatility of earnings because they did the way the accounting worked. And so mostly people passed. And I'd have to beg people at the end of an hour meeting, like, can we spend a couple of minutes on the alts? And sometimes they'd give me a couple of minutes and sometimes they'd say, no, thanks. That was the beginning.
What was their skepticism around?
I mean, the skepticism was, wait, why these are masters of the financial universe? Why are they selling stock now? And it turned out, coincidentally, it was right in the beginning because the financial crisis hit right after Blackstone went public and went from like 38 to 8 in 5 seconds. And so that just reinforced the stereotypes. The reality is it was the accounting, it was volatile earnings. You know, the mark to market of whatever investments that they had made the P&L go up and down. Again, I said they were publicly traded partnerships. They had K1s. A lot of funds didn't want to own that. They gave investors a lot of reasons to ignore them.
So how much of this transformation to more alts managers going public and also investors understanding them better came from the public equity investors poking and prodding and saying, hey, you need to change the way that you run your business or are structured? Or how much of it was the alts managers recognizing we're not trading well, maybe we need to change the way we think about our business if we're a publicly traded entity?
It's hard to separate those two because it's almost the same thing, but investors vote with their wallets all the time, and they were voting a lot. They were saying that's a single-digit multiple, and I don't care. And if you look, I track the top 25 mutual funds, which today is about $2 trillion. Almost none of them owned any alternatives in the beginning. So that's a hard thing to digest for these managers that spent the past year or two putting S1 together and explaining to the world what they did and opening up the kimono a little bit, and then trading like crap and having nobody own your stock. So they wanted to adapt. They did it for a reason. They want either monetize and transition founder management into the next generation, and or have a currency to attract and retain employees, and or have a currency to buy other firms and bulk up and get some free advertising. Who knows? But there are a lot of reasons, and none of them were working in the beginning. And at the same time, when they did talk to investors, the early adopters in investor land, they knew the businesses really well early on. And those that invested, would trade in these stocks and feel like they were worth this, but they traded like this. And they were very vocal with the management teams. And these management teams, they add value for a living. And so they had to do it to themselves. The same thing, how they help other companies get better, that help themselves. And they got good feedback from the investment community early on.
What was the tipping point that changed in terms of how investors thought about and understood these managers? So for context, Blackstone's 150 billion, roughly speaking, market cap. There's a number of other managers who trade really well. KKR is over $100 billion. And these stocks have, over the last 4 or 5 years, maybe there's some secular tailwinds, et cetera, they've traded really well. What was the tipping point that changed things?
There's never one tipping point, but what comes to mind is when they started converting into C Corps from publicly traded partnerships, they became more able to be owned by more funds if the manager wanted to. They still weren't in any real indices, so you didn't have to, but more could if they wanted to. And I remember telling the story of, remember in the asset management industry, I'm old, so I was around, I started covering the space in the late 90s. The traditional asset managers had just come off this unbelievable run. First of all, they trade at like 20, 25 times earnings because they grew 20, 25 times or percent a year. They had just come off a run in the mid 80s. I think household penetration of the U.S. mutual fund was 5%. By the mid to late 90s, it grew to 50%, which is where it sits today. Having that secular tailwind at your back is why there was a lot of growth and why lots of people paid high multiples for the space. And so once the alts managers converted to C Corps, people started thinking about that commentary and said, well, wait, if lots of institutions and basically all individuals had low allocations and rising allocations for reasons I'm sure we'll discuss, isn't this like 1988 in mutual fund land? And that's what started to help these get better accepted, more people doing work to understand them.
So how much of this growth in stock price of the publicly traded alts is more a structural tailwind, like you mentioned, similar to the mutual funds becoming part of U.S. household stock holding, and it's more about the broader structural trends and market versus the actual managers and their performance?
It's always both. Your questions are great. The tailwind conquers a lot. Rising tide does lift all boats. It lifts the better managers a lot better. You see the difference in stock performance in any given year is almost mind-boggling how wide of a spread it can be. A lot of times that will be individual performance, actual performance of the underlying vehicles. It will be which asset classes they specialize in. We might be in a better or worse real estate environment. That could be better or worse for one specific manager. It could be a more private equity backdrop, or what we just witnessed in 2023 and 4 and 22 when the market fell 20%, where private equity took a hiatus and all the credit managers or the more credit-centric managers massively outperformed. So it can be a combination of all those things. And that's something that was always fascinating to me with covering the traditional asset managers is where people's competencies were, where the concentration of their business can really have an impact in any given year's performance.
So what you've talked about over the past few minutes kind of combines a few different themes. One is it's hard to go public. You have to be the right structure. You have to have the right ambition. Question on my mind is, why would a manager decide to go public rather than just take a GP stake, minority equity investment from someone to help them grow, but they can stay private. They can stay in private markets. They don't have to change their structure of their business. They can stay in a partnership if they want. What's the pros and cons of both of those?
Yeah. And what's ironic is we're talking about them as businesses. This is the exact conversation they have with the companies that they go out and buy or finance over time. So for some of the answers are the underlying manager does want, as I mentioned, a currency to acquire other firms. Sometimes it's to attract and retain talent. Sometimes it's for the notoriety and it helps you fundraise and be seen around the world. That's not nothing. And some want nothing to do with being public. There are hundreds, if not thousands, of private markets managers that will either not be big enough and broad enough to ever get public or not want to deal with people like me having to ask questions of, just because the market fell this quarter, I want to know what expenses you might have cut this quarter. Like, that's not how you run a manager over time, but it's the annoyance of being public. So there's different strokes for different folks. I think the GP stakes market is amazing, and it can provide growth capital to those that want to grow that either don't want to be public or might not be big enough or broad enough to be public. And that's why those funds have attracted a lot of capital.
So what you're talking about there, I think, distills down to the concept of ambition. I had another guest on an Alt Goes Mainstream podcast, Jim Strang, chairman of the board at HG Trust, advisor at CVC. He said, ambition, everyone has it, but it's what you want to do with it. You really have to figure out what kind of ambition you want to have. You talk to so many of these CEOs and executives of the publicly traded alts managers. When you think about your conversations with them or how they've built their business, what do they have that others don't?
Sometimes it's vision, because you can have all the ambition in the world, but you have to do it with the right people and the right investors and the right structure over the right amount of time. Let's take any one of these managers that, let's say, the secondaries business is an excellent business and about to get even better. It would fit as part of any one of these managers that isn't big in that right now. You saw Franklin buy Lexington. And from what I understand, there were a lot of interested parties in Lexington. And Franklin won by being the highest bidder. So if you don't get Lexington, then you look around and you say, okay, well, Ares got Landmark. And you start saying, all right, there aren't that many more sizable secondary players to do. Do I go buy one that is not necessarily the best fit just so I could get big quick? Or do I just say, all right, I guess I got to build that organically over the next 10 years and I don't get to just jump in tomorrow. And so you have to be careful.
It's a really interesting concept to unpack, because particularly as you think about the growth in the wealth channel, distribution is so important. If we take that example of, okay, I'm late to the party as either a traditional asset manager like Franklin buying Lexington, another example would be BlackRock buying GIP, or an alts manager buying another alts manager. We've seen that happen a lot as well to add to their platforms. How much does distribution matter versus finding a great manager in a specific category to buy. So is it more important, like in your example, should an acquirer say, you know what, my distribution capabilities are so good, I can distribute a product even if it's not the best manager because there isn't the next Lexington out there, but it's still worth buying them because I am going to be able to distribute this?
You may or may not know how loaded that question is. So let's talk about it. Let's go back to my example of the traditional asset managers when they trade at 20, 25 times. Besides BlackRock and a select one or two others, lots of them trade at like 8 to 12 times. And you're like, what happened? And it's important. So I want to circle back to that, and then I can get to your very good question on manufacturing versus distribution. What happened was the asset management community was living large, growing at a very high organic rate as the tailwind of U.S. household penetration happened. You combine that with just markets go up over time, and that's a whole lot of revenue growth at high fees and really high margins. And what happens when you have an industry like that with low enough barriers? The world comes to play. And then you blink your eyes, and there are, true stat, more mutual funds than there are stocks. And then you have some performance challenges because there's friction in running a portfolio, trading costs, wherever. And then it's hard to beat certain indices or hard to beat your peers. You have more funds than there are stocks. You have performance issues. What's that lead to? Fee compression. Fee compression happens. And then technology does to this industry what it does to every other industry. It comes and replicates it cheaper, faster, stronger. And then you can't beat that index or ETF that comes at a low cost. And then asset managers trade at low multiples. So with your question for the traditional asset managers, everyone will always say manufacturing, but just make sure you own someone that produces top decile returns, because if not, you're an outflow. That's what's going on in mutual fund land. You bring that mindset to the alternative world. Mark my words, we are going to get there. I just pray it's like 10 or 15 years from now. Competition is coming. These products do have high fees, and they do lock up your liquidity. So why would you ever give them money? Answer, because they give you diversification and uncorrelated returns, and they need to produce better than publicly market available returns over time. They might not do that this year because 7 stocks, they don't own those 7 stocks, but they have to give that. That's the implicit contract with their client. So manufacturing, when it can produce returns over time that answer that, will always win, and everyone will find great manufacturing. Just not everybody can do that, and you can bring in distribution. And distribution relationships, this is a crowded channel that you're covering. And so the Morgan Stanleys and the UBSs and the Merrill Lynches of the world, they don't have room for more mutual funds than there are stocks. And they will not have room for 100 different perpetual private equity products. So distribution can win.
So what's the lesson here for alts managers if they want to not mirror what happened in the traditional asset management industry, which is fees have compressed, there's been outflows as a result, and then multiples have gone down?
Several things. The first thing I would say is discipline, meaning just because I want to be in the secondaries business doesn't mean that I can be. Who's you managing the money? Am I managing the money? No, we need people that have run this business in the past. Can you acquire talent from elsewhere, bring them on and seed new product? Maybe. Tough to get great managers in a growing industry like this out of another firm. Can you buy something? We talked about that. There may or may not be someone willing to sell to you, may not agree on the price. Like, it's hard. So staying within your discipline, right? I'm a financial services analyst that knows a little bit about the industry, but if my boss lost his mind, he'd have me cover healthcare. And who the hell is listening to me when I cover healthcare? Hopefully nobody. So you need the right expertise, and you need discipline over time, and find the right people, and then you can grow, then you can scale.
So if we unpack the answer to that question, firms at a certain size and scale will likely need to continue growing. There will probably be more firms that end up in public markets. They grow in size and scale. I mean, you hit 100 plus billion of AUM, you're probably starting to think about, okay, what's the next step for me as a business if I'm an alts manager? What does this market end up looking like? You have scaled platforms that are multi-strat, that are public. You have scaled specialists who focus on a specific category or vertical, and you have niche managers. How does this market end up unfolding in coming years?
It's an interesting time to ask that question because you're seeing a bit of a flurry of activity right now because there are, I'm going to make this number up, 10 and 15 type billion-dollar managers that they're not getting distribution on the Morgan Stanley platform, most likely. I mean, there are some unique products that get some of that, but they're not going to get the attention of 16,000 advisors in the home office because the home office, their mindset is we have sub 5% of our wealthy clients' money in private markets, and we think it should be 10, 15, and 20%. How do we get there? Well, we can't smell a small fund just because it's performing well in this niche area. We'll get some of that. But we need to deliver scale to our client base to accomplish what the distributor is trying to accomplish. So the good news is the distributor's on your side. You need to deliver them that value. So you're starting to see, well, not starting, you've seen a flurry of activity of those small to mid-sized managers that want to be part of something bigger, that thought they might grow forever down this path, but they want to get bigger faster. Like you said, you can go GP stakes route, or you can sell to a manager, and you've seen success stories.
Victory Park, Janus?
Absolutely. You've seen, I mentioned Franklin with Lexington.
Yep.
What about what Blue Owl did with Oak Street?
And Oak Street, Prima.
Right,
Yep.
right? I mean, they bought it with 11, 12 billion of AUM. A real estate manager, not the right product, but a real estate manager in a world where everyone hates real estate, and they bought that, scaled it from 12 to 28 in a pretty quick time. That's buying into and plugging into your established distribution platform and bringing your know-how of packaging the right product and plugging it in. There are some success stories. You know, you go back to traditional asset management land, there were lots of not success stories of acquisition.
So that brings up a really interesting question. And from your viewpoint as an analyst covering all the different publicly traded managers, do you think over time, also tying in with what you said about manufacturing is going to probably end up being more important than just having distribution? You think over time, the managers who are publicly traded, who actually have the competency to manufacture their own strategies or teams and products in-house versus acquiring, will be in a more advantageous position over the long term? Or will acquirers be in just as good a spot?
It's hard to buy a good firm, a good manufacturing plant, a good asset manager, and integrate it and be successfthere. There's not lots of examples throughout asset management history. It's lots of acquisitions. There's not lots of good examples of that. There are some in alternative land right now. I mentioned one with Blue Owl, but I am not convinced that you have a forever sustainable advantage in manufacturing. There are some freakishly amazing manufacturing firms in asset management land, and I think of like a Capital, Wellington, a T. Rowe, that are just somehow amazing year after year after year. It doesn't even mean that if they're public, it's always a good stock. They are great investment franchises. These companies that have gotten public in alternative land are absolutely incredible manufacturing plants that are getting smarter and creating products that speak to the world of underpenetrated alternatives within a portfolio. And we didn't talk about this, but the other secular tailwind for this industry is it's not that fun being public. So lots of companies that they might invest in the past might not want to be. We have government deficits all over that are going to start taxing higher, and so it might be more fun to be private. And some administrations are more regulatory tight, and so therefore some companies might want to go private. And these companies help facilitate all that. And financing options in the private world exist today that didn't exist then. And they're taking share from insurance companies and banks, and asset-backed finance is next. The point is, lots of companies are staying private longer and getting financed in the private markets. And another stat that I love is in the last 20 or so years, the number of public companies in the US has been cut in half, either through take privates or M&A or both. And the number of private equity-backed companies is up fivefold. So this is a pond that you must fish in, or else you ain't eating no fish.
So, on the topic of eating fish, other than the fact that you did that on your boat the other night with your kids, let's break down these managers. So, how do they make money, and what makes them great businesses?
Okay. Let's go back to the mutual fund example. There's always great things to learn from that history. Upon further review, one of the clear Achilles heels, besides that there are more mutual funds than there are stocks, and then performance came under pressure, so fees came under pressure. What goes along with that, which I didn't mention before, is they have overnight funds for deposits. There can be bank runs at banks because your deposits are yours for the taking, and mutual funds, you can have your money back whenever you want. And so sometimes performance goes bad and people take their money back, and sometimes just people get scared about the market and they take their money back. But they can take it whenever they want. That's only worth so much to the investment community if I was investing in that business. If I showed you a business that has more long-term locked up money, longer duration capital, that's worth more. Kind of simple. So when I think about the alternative managers and what might drive the multiple of a company, there are lots of things that come into mind. So the funding base, the longer duration your capital, the more of it in permanent or perpetual capital vehicles or GP stakes funds with really long lives, that's more valuable than overnight funds or CLOs that are shorter duration or whatever, right? There's a hierarchy of duration of capital. The capital intensity of your business. How much do you put on your own balance sheet, or are you just managing other people's money? Because I like managing other people's money. There's less risk in that. Some people like to use on balance sheet because you supercharge your returns. And it helps you capital raise if you're eating your own cooking and co-investing with your investor base, which doesn't get enough attention in the world. If you're a single strategy manager and the markets are hot for that strategy, great. You'll trade a really high multiple, but that's a little too boom bust. And what we've seen is the diversity of a manager's platform is helping smooth the earnings and revenue and growth stream. And so people want that diversity and will pay a high multiple for it. They'll pay more for FRE, fee-related earnings, than they will for spread-related earnings or performance fees, because sometimes the markets go down and we take a year or two off of performance fees like we are in the middle of, or hopefully the end of right now. What kind of margins you run? I mean, this is a high margin business where—
What kind of margins?
The margins of the companies that are still building are only in the 35-40% range, some only 40-45 on FRE margins. And KKR just put up a 68% margin in the last quarter. Like, I would say 55 to 60 is more the high end of the range. So these are incredibly profitable companies.
What are the real costs for a business like that?
People, and then some good people. But no, there's the investment talent is the business, but then you're building distribution. You have to build, and you have to build in advance, and you have to pre-fund whatever you're building. Like I said, if you want to build a secondaries business, okay, you're going to go buy something, you're going to go buy a couple of people and then build it over the next 10 years. It's a whole lot of uploading of costs.
So then if people, and probably to some extent scale, are the real costs, but also advantages, competitive advantages, what's the moat in this business?
Success is a really good moat. You work at a good firm, you get paid good money, You have some of the stock. You have carry in the funds. All right, how about this? And by the way, success breeds success, and you have a whole lot of money sitting in there. You're leaving, where are you going? You're gonna, and who's taking you out of that? When I'm having this conversation, I'll say, how about all those traditional asset managers that used to trade at 20, 25 times? T. Rowe Price, Franklin, Invesco, all of them. Excellent companies in their day. I asked the rhetorical question, why are none of them big private markets managers today built organically? Answer, because it was really expensive. They were public. They had to be careful of their expenses, and they weren't ready to front load 10 plus years of investment to be a big private markets player today. That's why it takes vision and money to build the right technology, to build these brands, to get the right people, to groom and cultivate these strategies. Like, you raise a little money in your first vintage, you prove to the world that you can do this and put up good returns over the first 5 or 6 years, then you can raise a second vintage. And then you do that, watch, rinse, repeat. You do, maybe by the third or fourth vintage, you've shown it over the last 10 years that you can do this and scale, and the LPs notice, and they're starting to write bigger and bigger checks. That's how you build the business. And so not everybody's willing to do that.
That's a great segue into talking about reasons why an Apollo, KKR, Blue Owl acquired Kuvar, an insurance asset management business. The reasons why a firm might want to add an insurance component to their business. Do you think this will maybe make other managers who would be thinking about that as a strategic move be a little more reticent to do that? Or do you think that something like that is such a structural advantage for those types of firms, as you've covered them over the years, that it's worth a short-term price to pay or pain for the long-term gain?
Yeah. It's more structural advantage. There will be some managers that don't want to go there. They're having too much success in too many other parts of the business. I use my eyes and ears a lot as an analyst, and I watched as Apollo, the investment community vomited when they bought in Athene, and the stock traded poorly. And then I watched over the coming years, just about every big successful manager try to emulate them, try to catch up and build direct origination channels, try to buy blocks of insurance business, maybe not do it on balance sheet to the same degree that Apollo does. I respect that. Some do much more third-party minded, but they're all still going down that path because it is a structural advantage.
If you talk about distribution being so important as you did, they've manufactured their own distribution.
They're going to produce about $70 billion of liabilities this year through the annuity channel and blocks that they fund. They have 16 origination channels, from aircraft leasing to fleet leasing to mid-cap, middle market lending, that as they produce these assets, they have liabilities that they've grown that they get to place them with. They raise third-party capital to co-invest with them. They put it on their own balance sheet, and they create products around that. They have created this huge ecosystem that is now leading to what might be their next huge frontier of, they've called it fixed income replacement, because just because a company's private, why can't they borrow from a private lender? We can talk more about that. It's important. And then it allows them to have capabilities to do these large, complex, customized transactions like they just did with Intel, where they buy 49% of Intel's huge manufacturing facility that's coming online, and they take that half the company equity, and they literally turned it into an investment grade stream of chip production, of cash flow. And then they put it into either their balance sheet, their third-party balance sheet. They raise third-party money that buys into it. That's interesting, and that scales.
That's an ecosystem.
That's an ecosystem.
And on that point, what's really interesting about that is we can talk about the short-term impacts of things like rates changing. Private credit managers, as rates have gone up, have tended to do well. So I think over the past 2 years or so, you've seen a lot of tailwinds for a lot of the private credit managers who are publicly traded, the Blue Owls, the Apollos, and then obviously the larger firms that have large credit platforms, the Blackstones, KKRs, Ares, et cetera. How much do you think rates changing impacts the credit managers relative to the long-term structural tailwind that you just discussed, which is there may be a new way of thinking about the addressable market in fixed income or credit, public or private?
Yeah, look, everything I cover is rate sensitive. Everything I cover is capital market sensitive. That's why they're called cyclicals, right? And so it'll ebb and flow. There are times where I like this industry so much. I think of it as a heads they win, tails they win type of environment. When rates were zero, with the benefit of hindsight, private equity and private real estate were having a bonanza. So were the public equity markets, right? When rates went up a lot quickly, it put the brakes on the public equity markets and delayed brakes on the private equity and private real estate markets. And so right there, you see where rates can wreak havoc and cause good and bad things. During that same time, rates were zero and investors were wandering the desert looking for yield, and they found yield in the private credit markets. When rates went up, they found more yield in the private credit markets because a lot of the stuff that they can invest in is floating rate. So if the forward curve is correct and 5.25 becomes 3.25, and floating rate investment funds that they're buying at 10 and 11% type unlevered yields right now become 9. 9's still pretty good versus 3. Forget all the other things that go into it. And so a little lower rate actually might help them a lot. Just even though higher rates help them, too high rates were going to start to be a bad credit environment. And so too high rates started to be bad for this industry. You take some of the rate edge off, financing's more palatable at a reasonable price, more available. You have less credit fears, and 3 versus 9 is more interesting maybe to sell product because 5.25, the wealth management world said, 5.25, I can kind of sit on cash forever, even though it's not that tax efficient. Maybe they found other things. So I actually feel like rates coming off along the forward curve can be an excellent thing. Will it slow some annuity production? Maybe, maybe not. This industry has grown through a zero rate world.
What were some of the most concerning trends?
The hurry up and wait on the recovery and bottoming in both private equity and private real estate. By the way, there's more encouragement than concern. I mean, it's been 2 years of concern, maybe more, 22, 23, 24, almost 3 years. The encouraging part is what I saw was there's a lot of deployment. There's a lot of money being put to work across many asset classes. I love that because people are finding value in things to deploy, and it creates more fees as they deploy money. It creates more capital markets revenue as they deploy money. We like deployment. What I would obviously like is, can you sell something? Can we
It's the other
sell
D,
something
distributions
out of
back.
Yes. And so LPs want their money recycled. They want cash flow. We've been waiting for 2.5 years for the M&A and IPO market. And despite strong equity markets, it's been limited. And so that's still an issue.
Do you worry about this record amount of dry powder? This is more specific to private equity than anything else, but it's record amount of dry powder along with a lack of distributions back to LPs as a concerning trend for publicly traded alts managers? Or are you not that worried about it given just all the other aspects of their business, the growth, the broader markets?
While the industry was in pure growth mode up through 2021, one of the things I loved was watching most players in the industry hang on to and grow their dry powder. there's a manager that I'll leave out their name that I saw in 2021 and has a great track record, deploy a new $11 billion fund in like 10 months at the peak. I was like, whoa. And then they went back to the market, tried to raise more. And that makes me uncomfortable because one of the things we learned with the benefit of hindsight is KKR protects their vintages by making sure that they're never buying everything in 1 year or selling everything in 1 year. They space out their deployment and their monetizations to protect vintages and do right by their investors over time. And I learned to respect that even more than I respected it before. I loved the discipline of the industry of growing dry powder, even though everything was growing to the moon. Not everybody just ran out and bought a software company at 80 times earnings in 2021 with all their money, right? There's discipline. And so I'm watching with scrutiny as we go, and I've noticed deployment's picking up because people are finding value. I love that. It'll show in returns over time. Remember my example of the mutual fund industry. Eventually, performance fell off, and that was a problem. This industry can't have performance fall off it.
So is the time to think about investing in these alts managers when deployment starts to pick up? Because you kind of want to invest in advance of that deployment happening. Obviously, it takes time for the J curve to end up getting through its deployment cycle and into the distribution period or harvest period. But is that a leading indicator or signal?
You know, I think I've tried to overanalyze all of this. We talked about the maturation of these as public stocks. Wow. In 2022, they fell off with the market, as you'd expect. And at the first whiff, only 2 years early, but at the first whiff of, maybe rates are done going up, maybe rates might come down, maybe the capital markets will get better, these stocks started coming back. And by the way, without the help of private equity and without the help of private real estate, these companies have put up excellent growth across the many flavors of private credit and growing in the wealth channel, in the secondaries business, in Asia, in the energy and the infrastructure platforms. I mean, they're just more dynamic and lots of areas of growth. And so, yes, deployment is one of the lifelines, the bloodlines of this industry, because some products get paid on deployment, not just on committed capital. Some capital markets revenues are driven by deployment. And you can't sell things at big profits someday if you don't actually have money in the ground. So dry powder looks nice, but it just looks nice. You need that, but these stocks have worked before deployment picked up, and now they're working a little bit again with deployment pickup. I think the next big thing will be monetizations. You saw a little bit of it. We need a lot more of it. But it's all these things. It's everything. They're too big and too broad.
Remember Around the Horn on ESPN?
Love Around the Horn.
All right, we're going to do that. We're going to do that. 60 seconds on each of the alts managers you cover. Let's start with the biggest, Blackstone.
Okay. They've shown incredible growth without the benefit of equity and real estate, and they're the biggest private equity and private real estate manager. So it matters a lot. Their stock has lagged because of the large concentration in real estate and equity. They have talked about the bottoming of both. You're seeing signs of the bottoming of both, and you don't have to look that carefully. Their stock has started to outperform a little bit after 2 years of underperformance. It's an excellent company. They're dominant in this wealth channel, and they keep innovating. They have a broad credit product coming. They have BXPE is growing as we speak. Their private real estate and BREIT is stabilized, and now low rates will help that a lot. BCRED and credit is growing, and they're about to roll out infrastructure. This might be time for Blackstone for the first time in 2 years for people.
That's an interesting point because they're massive scale and massive brand, which to your point, I think will help the wealth channel. The question I have is 150 billion market cap. You know, some of these bigger banks, like a JP Morgan is like 3 times the size of them roughly. Like, How big can Blackstone really get? Now, maybe they go from $1 trillion to $2 trillion of AUM. That's not unfeasible.
It's different, but some similarities. I covered BlackRock since it was a little baby. And I remember in 2010, 2011, 2012, writing reports, each one of those milestones, yes, you can grow a $2 trillion manager. They have $10 trillion today. So everybody that didn't buy that stock kicks themselves because great management teams find ways to innovate, evolve, invest in advance. So you tell me if there's 85 trillion of just wealth channel money that has a low single-digit percentage allocated to private markets when pension plans, endowments, and sovereign wealth funds have 30-something percent and growing as more flavors of private markets get involved. As the wealth channel gets better educated and better at selling these products and more products become available, we're not going to, and the distributor wants to take that to 10 to 20%. Blackstone was about 8 years ahead of everybody, has the biggest, broadest, well-known name, broadest platform, deepest relationships. They're not going to get more than their fair share. They get about 25% of their AUM is produced through the wealth channel as we sit here right now. And they think somewhere between 25 and 50% of any given year's new flows are going to be produced there. Yes, you can grow a $1 trillion manager in alternative land.
All right, let's go around the horn. Next, KKR.
Right now, they've been the darling for a while, but it took time for people to appreciate the breadth and diversity and everything that they were an overnight success over the last 20 years, building out infrastructure, building out real estate, building out their credit insurance platforms. Like they did it slowly. They did it the old school organic way in many parts, one vintage at a time. As you look now, they're just growing from every angle. They're more global than just about everybody. They have a real Asia platform that if the 25 and 30% allocations in the US on the institutions I mentioned here, it's a high single digit in Asia, and there's no reason why it's not going to follow suit. So they're deep in Asia. They have a great set of origination platforms built behind Apollo in the same kind of way. They grew an infrastructure platform from like 17 billion to 60 billion in like 2.5 years. They have really innovated in the wealth channel after Blackstone had this great head start. They've built out this K series with 4 core products, one in each vertical, and they're selling and branding and selling and educating and branding. And we're starting to see real signs of progress. And they're just getting started in so many of these channels. It takes time to get on the platforms and be well known and trusted. And they're going to raise $300 billion of new money across 30 different products between 24, 25, and 26. They put some big numbers out there over the next 5 and 10 years, and they do nothing but hit their numbers. I mean, they had that hiccup in a little bit lower insurance-related earnings over this year and maybe next, but everything else is kind of working really well at KKR right now.
Apollo.
So Apollo, we've talked about some of this, but it's a shame that they had to talk down the SRE. And it's important because it's, half the company or maybe more sometimes. So I don't want to, just gloss over it. But the innovation there has led towards potentially what they think is a $40 trillion market. If you can get public companies to borrow in size from private market players, it's just another funding source for them. There's an untapped world out there that they have the pole position in. They have the largest origination platform. They're the fastest growing insurance company. So that's one piece. And what's a shame is that they had to talk down that piece of the company because everything else was great this quarter. They had, FRE was up 17%. They had record debt origination, record deployment, record capital solutions revenue, $39 billion of capital raised. There's a lot of things working well that are not called retirement services at Apollo. And so them proving that they can grow through this hiccup in SRE and then get that big penetration of those large transactions with the Intels of the world, that's a big deal.
Blue Owl.
So Blue Owl is the other company that had a disappointment in the quarter for investors. They had to talk down their margin a little bit, albeit instead of 60% margins, something like 57 or 58. Again, think about those margins relative to basically any other industry on the planet. But a disappointment's a disappointment. They had to talk down margins, and then they upped their payout ratio a little bit for next year as a means to get close to that dollar of dividend that per share that they've been promising people. So it is what it is. That's a modest disappointment off a really high level. I think some of the margin degradation comes from the 3 acquisitions that they just made. I'll take that if it leads to half the success that they had. If they have half the success they had like they did with Oak Street in terms of buying something, growing it, helping them mature and plug it into their distribution, that's the, I don't want to call it a gamble, that's the investment that Blue Owl is making to broaden that franchise and tap into their established distribution.
And one of those categories is ABF, Atalaya, $10 billion manager focused on asset-based finance, which is a growing trend. That's a good segue into another diversified alts manager, TPG.
Yeah. And by the way, before we leave that, asset-backed finance, like, let's use our eyes and ears for a second. Middle market lending is how private credit got known and grew in direct lending. And that's as simple as a company that's private, not tapping the public debt markets because they probably can't, not borrowing from a bank because maybe they don't want to, or maybe they're just diversifying, or maybe certain parts of direct lending are better. But middle market lending is well known. It's like 850 billion strong. That's 850 billion of loans that used to be made by banks that are now made by some private credit entity vehicle. That's going to keep growing. Asset-backed finance is about 6 times larger than the middle market lending market. And just open your eyes, you're starting to see that same transition from bank lending to some private credit entity growing the asset-backed finance market. That's a big deal.
And it might have, certainly has different characteristics for investors, and in some ways, safer characteristics in terms of how they'd underwrite and what that means for investors who are investing in ABF funds.
No doubt about it. And it's also, you think about, again, building a portfolio for an institutional investor or a wealthy individual or family office. You bring in diversified product that's safe, that's yield producing in a world where rates are coming down. Some of the vehicles have certain good tax protections. It makes all the sense in the world that if the regulator is going to tax, if you will, regulatory capital-wise, the bank, that cost of funding those types of loans might not be as competitive as long-term locked-up capital. It's also, the regulator kind of loves it because it's not funded by overnight deposits on 10 times leverage. So in many ways, private credit industry is a much safer, backdrop to lend out that money. You're going to still see growth.
TPG.
It's interesting. They were that example of why go public? You're doing pretty darn good. Well, they used to be partners with Sixth Street. Sixth Street wanted to be on their own. They needed to find a private credit manager. And one of the ways that helped pay that was having a public currency that you could agree on price and finding Angelo Gordon. TPG had a great quarter, particularly in terms of fundraising and deployment. You can see the broadening of the platform help, meaning when TPG first came public and it was mostly private equity, you worried about the concentration and the potential for big cycles. You are already seeing signs that Angelo Gordon is smoothing those cycles of capital raising, of deployment, of capital markets, and it's still early days. and they can build on to the Angelo Gordon platform. So I think they showed a lot for what investors have been hoping for. They're still building some of their nascent strategies. It's still early days in terms of penetrating the wealth channel, but that's growth to be had too.
Carlyle.
So, Carlyle had a good quarter. No ifs, ands, or buts. It is a company that investors have had the most issue with in terms of what they are. And they had CEO transition and the founders did what they did, and they were late on building out the wealth channel. They have newer investments, but if you look at it, they promised grow our FRE margins, raise some more capital and try to broaden and diversify the business. It is far from over, but this was a good quarter in progress and a down payment on that promise. They still have issues to deal with, like scaling some of those new investments, penetrating the wealth channel, and fundraising in their core buyout products. So they still have more, but the second quarter was a good down payment.
All right. So we're on to the last word. What are you looking for next quarter?
I would love to see more signs of monetization happening. That's probably the next leg for the private equity and private real estate centric companies to show that they can, dig their way out of the last 2.5 years. Other than that, you just need further proof of everything we talked about in terms of the wealth channel, Asia, more credit products, asset back, infrastructure, secondaries, energy transition, like all that's there. So you just keep doing that and just give me a little more on the equity and real estate monetization side.
All right. That's the last word. This is Going Public with Glenn Schorr, Michael Sidgmore. Thanks for tuning in. We'll be back next quarter. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going mainstream.